We've got a spectacular panel with us today. We've got Thilo Hanemann, who's the primary author of this report and is a partner at Rhodium and is in charge of their trade and investment group. We've got Dan Rosen, who is the founding partner of Rhodium Group and is, of course, full disclosure, a director of the National Committee on U.S.-China Relations. We've got Rebecca Fannin, who is a former journalist, an author, and the founder of a news events group called Silicon Valley Ventures. And in Shanghai, we've got Ker Gibbs, who is the president of the Shanghai American Chamber and has had a career which has spanned both China and Silicon Valley. So we've got a spectacular panel. So let me turn it over to my partner, Thilo. Thilo, take it over.
Thank you, Steve. And thank you all for joining this year's official release of our annual Two-Way Street report. This is our fifth year. So the fifth report that we're issuing. And as always, our mission has been and will continue to be to provide objective data and analysis on US-China capital flows for policymakers, businesses, and the broader public. We cover two types of capital flows, FDI, so controlling interests in companies, and last year we've expanded that coverage to include venture capital financing, so early startup growth capital for technology firms. Looking back at those past 5 years, it was an eventful 5 years. We had at least three major disruptive shocks that have quite radically changed the two-way trajectory of capital flows between the US and China. And I thought I'd start with that, just a historical overview of how these flows have developed over the past 20 years, really. So on the slide, you see those two types of capital flows, both directions, an aggregate figure. And what really brought us to this topic initially was a really rapid acceleration of Chinese capital outflows, starting right around the last global financial crisis, 2008-9, and right when we launched our first report in 2015-16, that two-way capital flow story really got boosted by liberalization of policy on the Chinese side. So in 2014, China did make some moves to abandon outbound capital controls, which boosted global outbound FDI by Chinese companies. And looking at the US, we went from about 25 billion a year to 46 billion of Chinese FDI in the US in 2016. At the end of the year, Beijing had to backpedal. China retightened its outbound capital controls because too much of that capital was leaving, and subsequently that red bar here, Chinese FDI in the US, dropped quite dramatically. The second big shock that was impacting two-way capital flows over the last 5 years was a more defensive US policy. In 2018, Congress enacted FIRMA, which was a legislation to tighten investment reviews in the United States, which applies to all foreign investors, but was clearly initiated by concerns around Chinese investment in US technology companies and other assets. And that reform gave CFIUS, the oversight body in the United States, much more power over investigating Chinese investment. Moving into 2019, that more assertive US policy continued, and US-China trade relations took a negative turn with the US imposing tariffs, and we had multiple rounds of reciprocal tariff increases, which also weighed on sentiment. Now, at the outset of 2020, we are in that third big shock, which is the outbreak of the COVID-19 pandemic, which is really changing the global economy, and of course with it, impacting investor sentiment on both sides. So we clearly couldn't have had a better timing to set up this program and help the public understand how much capital is flowing between those two economies and what is impacting these flows. As always, for today, we plan to look back at what happened in 2019. So take a look at the 2019 data, but certainly even more important this year is we're going to put a greater focus on what is going to happen in 2020. So we want to spend some extra time today looking at how numbers have shaped up in the first quarter of the year and trying to make sense of the new world that we live in among COVID and hopefully what a post-COVID world will look like going forward. I'm going to start with a quick recap of the numbers, and I will begin with the traditional investment flow that we have looked at, direct investment. And one of the perhaps most interesting stories of 2019 is that American foreign direct investment in China has held up surprisingly well throughout 2019, despite the trade frictions and the escalation of US-China tensions. As you can see here, we have been pretty much on a flat line for US FDI in China since about 2010, 2011, at about 12 to 14 billion a year, fluctuating around that band. In 2019, we get to about 14 billion, which is slightly higher than 2018. And the most important reason for that stability is that most of American FDI in China nowadays consists of long-term, multi-year manufacturing projects that are geared towards serving Chinese consumers and the Chinese market. One of the most prominent examples, of course, is Tesla's Gigafactory 3 in Shanghai, which was built, I believe, within 2 years, and similar projects that are focused on localizing US operations in China to serve local consumers. So the made in China for China model. Looking at the industry composition, that becomes also clear from that perspective. The number one industry in 2019 was still automotive, despite this big slide in Chinese automotive sales. When US companies continue to invest in building out local manufacturing and switching to future technologies, including electric vehicles. Health, pharma, and biotech is another important and booming sector. So if you look at these two columns, this is the total 2019 amount, and this first column is comparison to 2018, and the second column here is a comparison to 2016, 2017 averages. So health, pharma, and biotech really is booming with that long-term play on an aging Chinese population and an underdeveloped healthcare system. And the third interesting trend here to look at, I'm neglecting electronics because that was mostly due to a low base and one or two outsized deals. One third really important trend to highlight, though, is the financial sector. We're seeing quite a bit of a movement there. The investment values continue to be low, but American banks and brokerages are increasingly utilizing the greater freedom they have, taking majority stakes in their local joint ventures. So that is a trend that we're seeing in 2019, and that's especially playing out right now in 2020. Looking at 2020 and the outlook, it's a very complicated question, and I'm very glad we have Ker Gibbs here with us to talk about it and get a live snapshot from on the ground. Looking at the data and the evidence that we have, it's a mix of opportunity and withdrawal. So on the one hand, COVID-19 is putting additional pressure on US companies operating in China. Obviously, as other companies, American firms are very much impacted by the lockdown, the slowdown in consumer demand, and overall weakening of the growth outlook. And that means that a lot of firms will probably have to cut capital expenditures in the Chinese market. There are some situations similar to 2008, 2009, where US firms have to consolidate some of their cash at headquarters and slow down overseas expansion. And there are also, of course, in certain industries, very strong concerns now about overdependence on manufacturing supply chains in China. We just had the news the last couple of days that US officials are working hard to draw semiconductor companies back into the US, building factories here in America. We see the same in healthcare and related sectors, PPE. So there's increasing calls for supply chain diversification that are going to impact certain industries. At the same time, certainly China has been a major driver of growth after the last financial crisis. And while we don't think that China can pull off the same kind of stimulus, China being one of the first countries being out of the crisis, is making a pretty strong case to continue investing there and creating additional demand to continue operations in 2020 above the COVID-19 trend. Another important development is Chinese policy. Beijing still has a few options to accelerate the pace of FDI liberalization. It has made some progress, but there are vast areas of the Chinese economy that are still either closed off or partially closed to foreign investors. So China moving forward on some of those industries and opening them up could entail additional incentives for US companies to invest and double down on their China operations. We look at the data points. So far, we're seeing mixed evidence. There are certain companies that are considering to pull out or that have already announced to downscale their China operations. But looking at our data, there's only been a really small decline in newly announced greenfield projects and acquisitions in China. So from about 2.8 last year in the first quarter to 2.3 this year. And if you look at company surveys, and I'm sure Ker can tell us a bit more about that shortly, the sentiment so far on the ground is that firms are reconsidering their investment trajectory, CapEx, but they're not yet thinking about radically downsizing their China footprint. Moving over to flows in the other direction, Chinese FDI in the United States. As I mentioned earlier, we have a fairly dramatic story to tell here. Almost nothing early in the 2000s, gradual increase, big boom, all the way up to 46 billion in 2016. And since then, driven by both Chinese capital controls as well as a more assertive US policy stance, Chinese FDI in the US has dropped all the way down to about 5 billion, a little more than 5 billion in 2018. And last year, we saw an additional decline to only about $4.8 billion, which is a really tiny drop in the bucket for an economy as large as China. And one particularly sad story, I think, is that we're especially seeing a decline in greenfield FDI. So despite trade tensions, which sometimes brings about so-called tariff jumping FDI. So in this case, Chinese companies building manufacturing facilities in the US, we'll clearly not see that happening, sort of akin to the example of Japanese firms. And so it's not a very positive story here when it comes to Chinese FDI in the US. Really quick, same chart as before, looking at the industry trends. No surprise, everything on the right-hand side is pretty much red. There's a drop of Chinese FDI across all the industries. The most interesting finding is that the biggest sector now for Chinese FDI in the US is the perhaps politically least sensitive consumer products and services, with 2.5 billion and almost 400% increase compared to last year. Another interesting development for the folks in New York especially is that we're seeing a bit of a recovery in the real estate, commercial real estate sector, although we're certainly far from the level seen during 2015 and 2016. For 2020, the story so far is that, not surprisingly, Chinese FDI into the US has taken another big hit in the first quarter. The Chinese economy was basically shut down. And so we only recorded about 200 million of newly announced Chinese FDI transactions into the US in the first quarter of the year, which compares to about 8 billion per quarter in 2016 and 17, and about 2 billion last year. So the start was very weak, and looking forward, there are some opportunities, and there's always opportunity in crisis. Certain sectors that Chinese investors have traditionally looked at, including tourism, entertainment, food, now have very interesting valuations. So there could be opportunistic buying for investors, long-term investors from China. At the same time, a lot of the headwinds that already existed are likely to be even stronger in times of crisis. Chinese policy has remained restrictive so far, and the macroeconomic environment that has fostered some of these policies has arguably become even more difficult now post COVID-19 outbreak. On the US side, the regulatory environment remains difficult. As I said before, CFIUS now has expanded power to review pretty much any equity investment coming out of China and elsewhere. And there is a big attention among regulators and policymakers on opportunistic buying by China especially. So politically, 2020 is going to be extremely difficult, especially as the bilateral relationship has further soured. And so you can only imagine what the headlines will be if any Chinese investor were to announce a major transaction to acquire assets in the US. So a fairly muted outlook from our end for the rest of the year here. Switching over to our newest edition of the data, venture capital. The story here was mostly one-sided for most of the past 2 decades. US VC into China was always a major driver of the Chinese tech ecosystem, started very early on in the early 2000s and has continued throughout. We're seeing big jumps since 2014, driven by a more vibrant Chinese tech ecosystem, bigger valuations, a more mature technology market, all the way up to almost 20 billion of American owned VC money deployed in China. A lot of that was driven by late stage rounds in big Chinese tech firms. In 2019, that has come down quite dramatically to only about 5 billion, in large part, for the most part, driven by a big correction in China's domestic technology markets, where valuations have fallen. The total number of funding rounds in the tech sector has declined dramatically. So it's not so much a policy story, but really a market-driven phenomenon here. That drop in 2019 has been fairly broad-based across really all industries. The only sector where we see resilience is health, pharma, and biotech, where the number of fundraising rounds with American participants has actually gone up in 2019. And this chart here just shows you a bit of a comparison in US technology interests in 2014-15 versus 2018 and 2019. So on the left-hand side, you see areas that are getting more interest from US investors in 2018-19 compared to 2014 and 15. And those are mostly clustered around AI, machine learning, big data, life sciences, oncology, medicine, and then we've got a bunch of more exotic technologies like blockchain and robotics in there as well. Our outlook for US VC in China is cautiously optimistic overall. The first quarter 2020 was difficult. A lot of startups were heavily impacted by the crisis, and deal making pretty much came to a halt because due diligence wasn't really possible to a great extent. But we're seeing a bit of a bounce back since March. And so for the first quarter, we count about 600 million or so of new US venture investment in China, which is about half of what the quarterly average was in 2019. So a substantial decline, but not as dramatic as seen elsewhere. Looking forward, what we can gather from market participants, and I'm sure Rebecca can talk about that during the panel. We actually see quite a bit of optimism. A lot of tech investors, the smart money out there, they think that the market correction we've seen since the mid 2018 has brought down valuations to a more reasonable level, and that really is creating opportunity for long-term investors from the US. And while there is a lot of talk about trying to prevent US pension funds and US institutional investors to invest in China, so far, most of the investors that I'm talking to are not very much impacted by policy. Switching over to the other side, Chinese VC investment into the US was not much of a story until really 2013, 2014, when we saw a big increase of that type of financing. And similar to the other direction, 2018 was a record year with about $4.5 billion of Chinese capital deployed in the US. By the way, this is pro rata values, so we're only counting the Chinese portion of a fundraising round, and that's why the number is quite a bit smaller than what you would see elsewhere from reports. 2019, there's been a decline, there's been a correction, but we only got pulled back to previous 2016, 2017 levels. This decline also pretty much impacted all sectors in the VC space. And if you look at the distribution of interest across technologies, a very similar picture as in the other direction, but with an even heavier focus on life sciences, things like oncology, and areas like AI, big data, autonomous vehicles are increasingly taking a backseat here. So very much a focus on health and biotech emerging here in Chinese VC interest in the US. Looking forward, so far, the data points that we can gather for the first quarter shows that VC investment from China in the US is holding up better than FDI. We count about $400 million of new Chinese VC money deployed in the US in the first quarter, which is slightly down from about $640 million in the same quarter last year. And so it's much more resilient than what people might think in light of US-China tensions and FIRMA. Looking forward, our outlook is a bit more pessimistic, and that largely comes from policy and regulatory action. So far, FIRMA did give CFIUS a mandate to look at startups, but we haven't really seen a whole lot of enforcement action in Washington that CFIUS was actually asking and poking around, asking venture firms to submit their deals. That, in my view, has changed now. The last 1 or 2 months, we're increasingly seeing deals being pulled into CFIUS, and CFIUS stepping up their enforcement actions in the venture space. So that, I think, is going to impact dynamics over the next couple of months. And certainly, there's also additional risk from the US government drawing up some of the missing parts of FIRMA implementation, including these lists of emerging and foundational technologies that are still pending. So for the rest of the year, I don't think we're going to see Chinese VC in the US going away, but we will certainly see more headwinds for anything Chinese in the US tech ecosystem. I'm going to just spend 1 more minute talking about our data assets. I've presented high-level findings. The report is online as of today. And in addition to the report, you can also find our data sets and some really nice interactive tools on our project website, uschinainvestment.org. Feel free to look it up. You can also sign up for a newsletter on project-specific data and publications. One last thing that I want to end with here, because I had a lot of pessimistic news. We are always looking to expand the coverage of our research project. And looking at 2020, seeing all these depressing trends in FDI and VC, one of the areas that we would like to focus on over the next 6 to 12 months is taking a closer look at other types of what we call portfolio investments, so passive holdings of bonds and securities. There are a lot of developments in that space. China just announced to basically abolish its quota system for foreign investors buying into Chinese bonds and stocks, the QFII system that will be abolished by June 2020. And so while we already saw some of these foreign portfolio investments edging up over the last 2 years, that could really be an interesting new development that will really push the level of American and other foreign holdings of Chinese stocks and debt securities. And so looking at broader US-China capital flows, that is one area that we will expand. And we hope that at the next event, we can talk a bit more about this new trend as well. I'm going to end here and pass it on to my colleague Dan, who's going to try to make a few closing comments on the broad implications of all of this for US-China relations.
Super job. Thank you, Thilo, and thank you, Steve, for hosting the project. Ker and Rebecca, thank you very much for joining tonight, and thanks everybody for tuning in on this topic. You know, I think it's fair to say any way you look at it, this is a pretty dark picture compared to where we were a few years ago when we started this undertaking. It doesn't do any good to describe it any other way. I would say the medium term is pretty much hardwired to be dark now, even if we had a very constructive state of mind in Washington, Beijing, it would still take a couple of years to get business confidence back on track. Normally, an economic downturn creates M&A buying opportunities by repricing assets, by making everything cheaper. We were talking a little bit before we got started. Thilo was pointing out that it looks as though Amazon, I think, is likely to buy AMC theaters from a distressed Chinese seller. That would be an example of an asset that, you know, right now it's a little hard to get excited about buying movie theaters, and yet if asset prices fall enough, it creates this cross-border and intra-nation flow of acquisition activity, and that's just how markets work under normal circumstances. That's part of the solution. But this is certainly not a normal downturn. It will be years for investors on all sides to reevaluate the underlying value versus the risks of opportunities, investing in their own home economies, and all the more so when you introduce the political risk of crossing a political border to invest somewhere else in the world. Moreover, this investment picture of diminishing activity is certainly not new to the COVID era. As Thilo has described, the basic trend here of things starting to turn down a bit very much predates COVID and has been the tendency for several years now. It is a systemic shift in what was a structural new channel in the US-China and China global economic relationship. While what Thilo just described into the US is the steepest downturn of Chinese activity in an OECD economy, the same pattern of Chinese numbers coming down is found elsewhere in the world, for example, in the European Union. That speaks to the principal driver of all this that Thilo described, Chinese concerns about balance of payments and capital outflows as being the predominant variable in the story. I would say that engagement, including two-way investment flows between China and the US and China and the rest of the advanced market democracies, was never a given. It was, it is today, and it will be in the future contingent on convergent systems that we believe our economies and our companies and the way we organize our societies and how we do business are getting more similar, not less similar over time. That was the foundation of this growth that we were starting to see, which was really just in its infancy and still is just in its infancy, as big as those numbers had gotten in venture capital in 2018 and in overall FDI back in 2016, that was still a fairly modest starting point compared to activity between two fully like-minded economies such as Germany and France, or Britain and the United States. And so there was a lot more to come, and there still is a lot more to come, of course. Thilo alluded to Rhodium Group's concerns that China's ability to stimulate its way out of the present circumstances is nothing now like it was a decade ago. And so the shoring up and reduction of finance risks at home in China is not going to happen quickly. It's going to take some time. It's not going to be a 2020 story in our view. All things equal, that will tend to limit the potential for a sort of outward boom of Chinese opportunistic buying, either commercial in nature, presumably, or for any other motivation as well this year. That's an important geopolitical consideration that we might want to talk about a little bit more. If there's a constructive note for me to finish on here for our initial presentation and hand it over to the two excellent speakers behind me, is that the long-term picture between the world's two largest economies still holds potential for really very massive two-way flows of investment and activity in all the channels that we're already documenting, and those portfolio channels which are still to come for China in the future. And I would also say, to close my brief thought here, that the basics of that systemic convergence, which I said a second ago, is the necessary precondition for this commercial activity. The basics of that convergence are still getting pretty full rhetorical endorsement, both in Beijing and in Washington. There are things that are happening in Washington I can point to now which don't seem so market-oriented to me, to be frank with you. And there are certainly plenty of things going on in China the past several years, and including this year, which I don't think are compatible with the way I'd like to see my market system run and regulated in the future. But there are some pretty interesting green shoots. Next week will be a super important test point to see how much seriousness those have, because the National People's Congress will be sitting after a delay. And there are some interesting statements that have been made by State Council and leadership over the past couple months about the importance of reform and laying the groundwork for China to have a sustainable, healthy, and globally compatible recovery that can set the table for us to get back to talking about how much upside we have, rather than having to worry about just how deep the dive is, as we've just seen in the numbers. With that, Steve, I look forward to the conversation with our panelists.
Great. Well, let me, rather than starting to, I have only a dozen questions. Rather than starting on those questions immediately, let me first turn to Rebecca for some comments on that, on the presentation and on what's going on in the VC world.
Venture capital is always a cyclical market in any case, but certainly all of this cross currents have created even more cycles in the venture capital world. Today, we saw the peak of venture capital, China, US, just 2 years ago, and now we're seeing the downside. And I think the outlook, is important to look at as well. The outlook is that a lot of the venture capitalists are now dealing with struggling portfolio companies and spending more than half of their time just helping these startups to survive. But on the other hand, it's a good time to invest. Innovation is at a heightened level. We're seeing lots of new ideas, and venture capitalists say that the best time to invest is in a down cycle. The best companies come out of that. And some of them have raised new funds just recently, so they're ready to go. Valuations are down slightly from what they were, and there's a lot of technology that's definitely developed in the past few years in China that in some cases can rival what the US has. So we look at drones, we look at autonomous driving, we look at mobile apps, You look at robotics, life sciences, fintech, all of these areas are areas of interest for venture capitalists. So we're going to see, I think, another boom coming. I don't think that this is going to be dark ages forever for US to China, but I do think that we will see kind of a separation of the strongest from the weakest, which we already have seen to some degree over the years, that now today there's a core group of venture capitalists from the US that are investing in China, and that a core group that in China that have emerged, whereas before it was a much bigger pot, but it's now come down to a core group. And that core group is a very strong elite group. And I think that they will help to fuel new investment into China. The flip side of China into the US is much more uncertain, because that's much more driven by regulations in Washington, DC and Beijing. So that's a little bit of what I'm seeing here from Silicon Valley. I do have to say that all of the China into the US venture capitalists, there's just been tremendous disruption of China venture funds that were heavily investing in the US before. That's just gone. The capital is gone. The teams are disbanding. New funds are being created that are US only oriented. So tremendous disruption, China to the US. But I think there's an upside US to China and within China as well.
Fascinating. Ker, the view from Shanghai and your members.
Yeah, Steve, thank you very much. And yeah, it's my pleasure to be here today, and glad to add a little bit of color to what you, Steve, and Thilo and Dan have been saying about the market, and add some color from thoughts on the ground here in China. First, it's great to be collaborating with the National Committee on U.S.-China Relations and also Rhodium. Both organizations do excellent work. We've cooperated with Rhodium before to support their work, and it's important. We look at the Rhodium Group's data because they have a much more comprehensive view of the data on investment flows. Here at the American Chamber, we also look at the data on investments, but we look at it from just a very, very specific slice. In other words, the American Chamber here in China, I'm based in Shanghai, and we just look at our members and what our members are saying about investment, and that's only one slice of the investment pie. And Thilo mentioned passive investments, and we'll come back to that in a minute. But we have about 3,000 members here on the ground in Shanghai, and so we just look at that. And the primary focus for that group is the so-called in China for China. They're investing in plant and equipment and teams here in China to support the market, to produce goods and services for the China market. So that's just a very specific look at the data. It was alluded to before. I want to go back to the data that Rhodium Group and Steve, you alluded to it as well, or actually, sorry, Dan, I think alluded to as well, as your data looked at about 2010 of sort of flatline. That's roughly consistent with our data. We looked at it. We sort of see the inflection point at about 2012, where we saw a decline in investment, U.S. companies investing in China. And I bring that up because I think we're looking at 2019 and 2020 data. You have to look at it within that context. And I don't think there's anything particularly sinister about that decline and sort of, no longer, have lost the loving feeling for the China market or anything like that. I think it's our interpretation of that data is that it's mostly a reflection of maturity of the market. When there's not much plant and equipment in the market to begin with, then everything has to be built from scratch. And at this point, the China market is, it's fairly mature, frankly. And so the level of investment isn't what it was in, say, the 90s and early 2000s. Having said that, in 2019, our data did show a fairly dramatic drop. So we collect that data slightly differently from the way the Rhodium Group does. We ask our members, are you planning to increase the level of investment this year over last year, which is just a slightly different way of asking the same question. And we actually saw about a 20-point drop in that number in 2019, which was fairly dramatic. And that coupled with another question that we ask, which is sort of the overall optimism level. and that dropped as well by about over 20 points. And that's largely, trade war related. I mean, that's clearly a sentiment in the market that it's a reaction to that. And there I want to jump in. Actually, one of the questions that was submitted, I may as well attack that. There was a question that was submitted, or I guess we were discussing this earlier on the call, is Chinese policy generally, right? The question was, is Beijing trying harder to roll out the red carpet to foreign or U.S. investors, and what would be the game changer there? I would actually say yes, the red carpet is being rolled out, but not by Beijing, and that has to do, I think that connects also with the overall sentiment of business over here in China. There's a lot of frustration with the discourse that's happening between Beijing and Washington, D.C., and that's very frustrating. And Steve, I think your introduction to the report alluded to that as well. When COVID happened, and the society in generally was looking at it and say, wow, we have especially when it hit the United States and hit Europe, the overall sentiment was, wow, we have a common enemy. This is definitely something we need to cooperate and attack together. And we need to be sharing data. We need to be cooperating in every way possible. And there's a lot of disappointment that has not taken place, that the opposite of that is what seems to be happening between Washington, D.C. and Beijing. In contrast, the sentiment here on the ground at the subnational level is, I would say, absolutely yes. The red carpet is being rolled out. China at the working level absolutely still wants U.S. investment in this market. They welcome it. They're very business oriented. I just got back. Last week. I was in Suzhou meeting with some of my counterparts out there. They're very eager to welcome further U.S. investment, and I think that will come. I mean, some of the, I guess, two thoughts. One is to some of the things that Thilo was mentioning. Yes, there's sort of a weakening of the growth outlook, and that happened right through 2019. So we had that, but I would say the sentiment here is fairly optimistic that China will be early out of this crisis, and probably will have a better experience in the recovery. Now, again, it's pretty early in the process to make, sort of GDP predictions or things like that, or what shape that curve is going to look like. Will it be a sharp V? I'm not going to sit here and tell you that I know it's going to be a sharp V or versus a long U. But the way China has managed things like this in the past does give us some reason for optimism. I'll make a quick comment about something else that came up. I think it was Dan that was talking about, yeah, we're not going to see huge stimulus measures from China, just given their situation with respect to their existing debt levels. And I think they are going to be fairly conservative. Having said that, they have been very aggressive in terms of the rescue packages, I guess you could say. And they're focusing on exactly the right areas, which is the SMEs. So the looking at the two key cost drivers for SMEs, and that's payroll and rent. So they've taken some aggressive measures there to give relief to SMEs. Having said that, that is the sector clearly that's going to be impacted. And again, Thilo referred to downsizing or pulling out of U.S. companies here in China. Are we seeing that at the SME level? Yes, we are seeing that. We've already started to see some bankruptcies. My guess is that that's going to accelerate. And we're talking about sort of companies that are sort of 50 to 80 employees and below. They're struggling to make payroll. They just don't have the cash reserves to sustain this kind of thing. At the larger company level, no, we're not seeing really any shift in commitment to the market. So that's very strong, and I think that they will continue to invest going into the future, really on the back of the consumer story, healthcare, and financial services. I would say those are the three sectors to watch. So I probably have further comments about supply chain and things like that, but maybe we can leave it there and open up to questions or however you want to move this.
I see we already have a dozen questions that have been sent in and then some which were sent in advance. The first question, Thilo, kind of jumps out. The reduction in Chinese investment to the US, how does that compare with the reduction of Chinese investment to the EU, the UK, Japan, South Korea?
Yeah, that's a great question. And the short answer is Chinese outbound investment has been declining globally. So if you look at Chinese outbound investment, there's different data points, different measures we can use, but largely speaking, we're back to about 2014 levels in terms of total Chinese outbound investment globally. Some regions, countries have held up better than others. And the US is certainly on the lower end of that spectrum. So the European Union in the last 2 years have received about twice the investment from China than the US. So there is this bit that can be probably explained by more restrictive US regulations and US-China tensions. But again, my basic stance is 80% of that decline is related to Chinese outbound policies. 20 or 30% is related to host economy policies and market dynamics.
The US venture capitalists have participated in some of the spectacular deals in China. Have you made any attempt, I guess it would be for Rebecca or Thilo, have you made any attempt to kind of, you're calculating it based on cost basis, which for FDI may be sensible, but when you're doing 100 times or 50 times you're going in a VC deal, what would that number look like if we were marking to market in 2020?
Well, I think, Steve, that's certainly correct that a lot of these US funds have made a killing in China during the golden era. But it's hard to really calculate the returns because a lot of that data is private. But I would perhaps say that this golden era is over, right? So there was this period, the past 7-8 years before 2018, where these deals were possible. Competition has grown, and these outsized returns, I think, are more difficult to achieve now. And I would also say, it's maybe a little too narrow to just look at this from a VC lens, right? If you consider FDI, for example, a lot of American companies have certainly made very outsized returns as well, just purely by being in the market for, Ker referred to it as plant and equipment, real estate. So if you would mark these assets to market nowadays that were put into the Chinese market 20, 30 years ago, you probably get even better returns than in some of these VC plays.
Interesting. Ker, in China for China, do you have data on what percentage of the investment of your members are done in China for sales within China, and how much of it for export back to the United States or export elsewhere? And do you have any, this would be for everybody, is there data on how much US companies repatriate out of China in profits? Ker, you're muted. You're muted.
Yeah, thanks. Are we unmuted now? So, Steve, I just wanted to address what the previous question real quickly. Yeah, I mean, because I was an investment banker in a previous life and was in that world. And yeah, people, I think the answer is they made a killing, but, and there are opportunities going forward, but there's been a big shift from US dollar VC funds, and now it's most of the VC investing here in China is actually done in RMB. So locally raised funds, whether it's still Shen and his group, but raising RMB funds as opposed to US dollars, and that has to do with kind of two things. I mean, one, it gives them more options in terms of listing and getting that liquidity event, but it also is impacted by this so-called decoupling conversation, and especially around the technology space. So, again, doing investments in RMB gives more flexibility. In terms of the question you answered about the investment percentages, the in China for China. We don't track the investments that way. Maybe Thilo does, but we don't look at passive investments, and that's something that Thilo brought up actually. And we do see that as a big opportunity here, meaning so if the VC opportunity in U.S. dollar funds maybe has decreased, what has increased is the opportunity for asset managers in making passive investments in the market, maybe mainly in public equities. And so that market has been liberalized. And we see big opportunities there for asset managers. Quite a few of them have come into the market in recent years, and we expect that trend to continue. The other trends, as far as the sort of so-called in China for China model, the big shifts that we've seen within the American Chamber is also a dramatic shift from manufacturing over to services. So the majority of our companies now are much more in services as opposed to manufacturing, and that trend will probably accelerate. So again, I think what's happened with both the trade war and COVID is these things have accelerated trends that were already there. So I think a lot of attention has been paid to the supply chain equation moving out of China, especially at the low end. The trade war accelerated that. COVID will probably broaden that trend as companies look to diversify their supply chains. And that conversation is definitely happening. Again, you don't see a dramatic shift, everybody sort of pulling out of China. You're not seeing that, but you are seeing much more serious conversations at the board level in terms of looking at China much more in terms of risk-adjusted opportunities and also risks. I mean, now that it's clear to everybody that global supply chains actually can be shut down by a virus, this is a new element in that equation.
But if you're in China for China, it's somewhat that calculation, whatever.
Exactly. It does give you, when your production is in the same place as the demand in terms of where you are in the recovery cycle, you're in a much more advantageous position as opposed to having your business scattered from all parts of the earth that may be in a different part of the cycle in terms of recovery. That makes a much more difficult business to manage. So long-term trends going forward, again, I'm not seeing a huge shift out of China, but I am seeing a shift towards thinking about businesses in more of an autonomous unit, as opposed to, and looking carefully at these dependencies that cross borders and cross regions that may be impacted differently by things like a virus.
Thilo and Dan, anything you guys wanted to add on that, or I'll go to my next question?
The only other element that we didn't already touch is profit repatriation. This has been a sticking point with, I would say, antiquated regulatory impediments on the Chinese side to firms repatriating their hard-earned profits. One of the other elements that came along with the most recent opening to QFII investors is some assurance that their profits will not be held up by bureaucratic drag at the border. But if they go in and succeed in the tough market of China, they'll be able to do what they want with their earnings. It's been important for Beijing to underscore that, because even in the high-tech Chinese companies, there's been a lot of state intervention in the past couple of years. And so folks, both on the real side and the investor side, are quite concerned to see some assurance that the market's going to be permitted to operate, freely and normally in the future, I would say. So I would just add that on the profit repatriation point.
And Steve, I have one addition to Ker's point about this tendency towards, I guess, sort of a new dimension of localization or sort of localization of operations. I think U.S. companies will have a much will have it much easier to deal with that than Chinese companies. So if you look at two-way flows, we're seeing very few examples so far of Chinese companies following that approach into the US market. And so when we look at that two-way balance, I think US multinationals being in that position for 50, 60, 70, 80 years will be better able to deal with that challenge than their Chinese counterparts.
Dan, I loved your kind of contingent on convergent systems. Can you explain that? I think, you know, is that because of, you have to explain to me what that meant.
Oh, well, that would be a very long discussion. We should get a good bottle of wine, Steve, as soon as
in short.
But in short, I mean, there's something we do, you know, over at Asia Society called China Dashboard, which looks at Chinese policymaking in 10 different basic domains, things which are not generally understood ideologically, but simply in terms of market efficiency, to do with fiscal policy, basic competition policy regimes, trade policy openness, and cross-border investment is one of them. And in all of those areas, early in the Xi Jinping years, the leadership set out the task of taking the next set of steps in the long-term reform and opening adventure that China had set out on 4 decades ago. And in almost all of those areas of what was called the 60 decisions back at the third plenum of 2013, there's been very, very mixed progress toward the goal of continuing the process of kind of marketization. Most recently, some very large and sort of abstract announcements about installing new market allocation systems for capital, labor, and data, which nobody else in the world treats data as something that needs a government regime to allocate it to companies. It was generally seen the opposite, as kind of born free. But the basic disposition of the state toward the market in China is something that is in flux. It is not today exactly what it was 5 years ago. Even the role of party committees in corporate governance has changed quite a bit from where it was expected to head 5 or so, or even 3 or 4 years ago. And there's tremendous debate and discussion about whether to interpret these things as just cyclical blips, 2 steps forward, 1 step back, or whether we have a more structural drift back in a state-oriented direction taking place in China. I will observe that the sort of affinity for state solutions to market problems is not uniquely a Chinese phenomenon. There are others in the world who are also, not even just in the COVID context, where of course the state is always expected to step forward in a situation like this. But even pre-COVID, some government authorities have been thinking, well, maybe we can do better if we plan with industrial policy like China does, rather than leave it for firms to fight it out in the marketplace. So a lot of very philosophic debates taking place in the sort of think tank lane, I would say, and we should do an event soon to talk about some of those things.
Should. Let me take some questions from our audience. I see we've got lots and lots of them. This is from our USC member, Clayton Dube, who asks, and presumably the decline in investment in North America and Europe hasn't been mirrored in increased Chinese private investment in BRI projects. Are US companies in China, e.g. Caterpillar, GE, Trimble, et cetera, still hopeful of getting contracts related to BRI projects?
Thilo, can I take the first crack at that? Just because it's such a fun question. Let me do that. So I would simply point out to that one, and Clay, great to be on the line with you, that the kinds of investment opportunities in Botswana or Kazakhstan or even Chile or Brazil are not comparable to the kinds of investment opportunities in an advanced economy such as Germany or the United States, right? And so you can't simply say, I'm not going to invest in Mountain View, California. I'm going to go do it in Turkey instead. Those opportunities, both greenfield and M&A, simply do not exist in the BRI world to substitute for the opportunities and motives for Chinese companies to want to be in the most advanced economies, the United States and Western Europe. BRI as a separate theme, not connected to our FDI topic, is definitely very interesting, and it's very important potentially to many American firms like Caterpillar, like CAT, as you just mentioned. But I would say it's not connected to the ups and downs of the FDI story as we've been tracking them here in this series.
Ker?
Sure, I'll take a crack at it. I mean, BRI, it's interesting. I mean, it's in some sense, it's an area where the U.S. and China are in violent agreement in the sense that China doesn't necessarily. I mean, they give lip service to including U.S. companies in some of the BRI projects, but we have yet to see real meaningful participation in that. I think it's going to be kind of an interesting view going forward to see how much enthusiasm BRI continues to receive now, sort of post COVID. There's been a lot of back and forth in terms of China's position or the receptivity of BRI infrastructure investments from China. So it's been a bit of a roller coaster ride. So hard to see the long-term trends, but at this point, it's probably going to be a changing landscape for the next year or so. That'd be my take on it.
Kimberly Mullen asks, hi Kim, would you please speak more to the potential impact of Made in China 2025, 2035 on investment focus, US to China and China to US, particularly within technology?
Well, I'll take a crack at it, Steve. I mean, 2025, that is the issue, in terms of, looking at the U.S. business community, the ones that are here in China are the ones that have found sectors that are open to them from a market point of view and an investment point of view, and no equity caps and things like that. The 2025 model, lays out the strategic industries of the future, and that those are the ones that are more controversial. And so it is tough. I mean, I think what most of the American companies do when they're based here in China is they look for sectors where they have a lot of running room and tend to invest in those sectors. So consumer is wide open, healthcare wide open, tech not so much. And that's why the Tesla investment was such a big deal, is looking at China allowing a wholly owned business, not just in automotive, but in electrical vehicle. So that was a key move on behalf of China, and I think a smart one, to show that there is room, at least in that part of the 2025 plan, which includes electric vehicles. So everybody wants Tesla to succeed. Tesla obviously does, but China does as well. They want to show that an American company can be successful in a tech field and within electrical vehicles. Having said that, China also very much needed Tesla. I mean, the electrical vehicle market over here has been a mess. Almost 200 different companies, all doing different things in EV at various levels of success. The spectacular struggles of NIO, which would be kind of maybe the closest equivalent to a Tesla vehicle. So in order to bring maturity to the market, it was a positive thing to bring Tesla in.
Yeah, I was going to comment on the electric vehicle industry as well, and certainly Tesla is an excellent example. But the China to the U.S. side, we're seeing a lot of R&D for the autonomous driving, China into the U.S., China R&D for autonomous vehicles and electric cars together in Silicon Valley and in Los Angeles. You're seeing many of these Chinese companies doing heavy R&D with engineering teams here in Silicon Valley and also Los Angeles, kind of a new Detroit of the US and of the world, maybe. The Chinese electric vehicles, I mean, you're right to say, definitely some of them seem strong in the beginning like NIO, but others, we've certainly seen a separation of the stronger ones.
Steve, let me add one thought that picks up from that question and addresses another one I saw in the Q&A chat concerning what industries in China are the most important priorities for us to see opened next, to, you know, wider to foreign investment. And I think part of that larger issue, that collision between American interests and Chinese interests that is the elephant in the room here, is that the era in which industrial policy can favor some promising industries in China and FDI policy is going to open a few next, but not just move ahead to general reciprocal openness to all foreign investment without any of this kind of special tinkering about the regime. That era is over, I think, and China's global competitiveness, its ability to be world beating in so many industries, if not already in the leading place, as the panelists have noted, on the cusp of it, means that it's time for us to fast forward to a time when we don't have to worry about whether China 2025 or the new China 35 initiative that I heard about the other day, or the next FDI opening announcement, pick some industries that the President of the United States has to be concerned about, but not others. And so it's putting market economies in an impossible position where their leaders have to make these kinds of political compromises around basic economic access to a market, which already generally has had unlimited access, right, back in our economies over the past several decades. Now we are starting, unfortunately, as we discussed before, to consider implementing some industrial policies, some greater restrictiveness on our side in the OECD, which to me seems more like a detour in the wrong direction than the right long-term fix for our competitiveness. But that is the reality of the moment.
Andrea Schellel asked, will a change of presidents make a difference? Will the trade deal fall apart or be renegotiated? What do you think the effect of this will be on two-way investment? Any volunteers?
This will be fun to see who steps up first if I don't, because I always rush in on these dangerous questions, but I want to see whether Rebecca or Ker want to take a swing.
Yeah, well, maybe we'll have a president who won't call it the Chinese virus.
I'll add to that the phase one deal, the U.S.-China Economic and Trade Agreement signed on January 15th, doesn't really have most of the necessary attributes of a meaningful U.S.-China economic deal, in my opinion. It's a managed trade arrangement that was designed to deliver very specific values of benefit to one side in a manner that was totally out of line with America's multilateral commitments, and for that matter, China's multilateral commitments under the WTO and other agreements. And so I should hope that the next American leader takes our strategic regimes put in place with China back in the direction of compatibility with the rest of the world, and also in a direction of approaches that are going to be sustainable and resilient over time, and not dependent on us not having a recession, which we're having now, that make it essentially impossible to implement that deal anyway. So that's what I think.
Anybody else want to jump into that one?
I guess I'll add a little bit to that, Steve. You know, there's a lot of people are saying, you know, the one thing everybody's agreed on is, you know, between the R's and the D's is, you know, they all hate China and they're all sort of unified on China. I would pick a fight with that particular narrative. The way I see it, the Dems and Republicans are both unified around the what. I don't think that they're necessarily unified around the how, and that's probably one of the discussions that's going to play out between now and November and beyond November, depending on who wins. In other words, there's general agreement that the current course and speed is unsustainable between the U.S. and China. I think that's clear. What's not clear is how we get to a better agreement. And to Dan's point, I would very much agree with that. The phase one is really just a ceasefire, and the elements that were in there, other than the ag purchases, a lot of those kinds of things, the IP agreements and currency, I mean, these are things that were largely agreed to, or at least directionally they were headed towards agreement anyway. It's a little bit surprising to see why it took 18 months and a very damaging trade war in order to get to those particular outcomes. Now the ag purchases is a little bit different. I agree that's managed trade, and again that should have been a reasonable negotiation. I don't know why it would have taken the tariffs. So, but back to the point of what will look different on the Democrats, I think, well, two things. I think the tone may be different. It'll be a different negotiating style for sure. And I think it's an open question as to whether a more cooperative stance will get better outcomes out of China. But the second thing for sure is there's been a philosophical discussion about a philosophical decision on the part of the White House that they're going to do this negotiation alone. This will be a bilateral agreement. The president likes bilateral. We've had that conversation with the White House. We've had that conversation on the Hill. And there's just agreement that this administration does things bilaterally. It's a waste of breath to try to convince them otherwise. Democrats, they just have a different approach with respect to that technique. So again, I would say it's not necessarily a difference in the what, but it is a big difference in the how.
Even though the business community understands, I'm sure your members would prefer this be done multilaterally, and that the business not be shifted away from American companies to others if we're the ones who are in the doghouse for that particular problem.
Exactly. We've been broadly supportive of the administration's approach to take a tougher or more deliberate approach to China, to get better outcomes, to get this relationship moving in a different direction. We've been supportive of that. What we haven't been supportive of is the tone, the aggressive tone, and certainly the tariffs that have been extremely disruptive. So yeah, we've communicated that to the White House. Here we are.
I could ask about last week's regulations, but well, that's a whole different, since that governs U.S. exports, not investment, and it was not coordinated multilaterally. We did a program on that last week. Helen Lee asks, can you comment on the outlook for Chinese companies looking to list in the U.S. capital market with some recent controversies? And then a little later, someone else asks, let me see. Oh, Chris Murphy. Is the Lupton scandal indicative of a broader problem with more examples likely to come, or is it a one-off incident with limited significance for investment trends? Thilo,
Well,
you wanna?
Yeah, the
Rebecca,
Luckin Coffee example, it has certainly gotten a lot of press. And, I have heard of some other companies that have been accused of inflating figures, but I don't think it's, necessarily a broad problem. I think it's more, maybe a couple. We did see just on Friday a successful listing of a Chinese company in the U.S. on NASDAQ. It's the first one since this whole coronavirus craziness began, and it did well. So maybe there is a more positive outlook for Chinese IPOs in the US. Although on the other side, we had been hearing that there may be a stop to Chinese listings, but that was mainly because of political reasons, I think.
There are simmering SEC issues to do with accounting standards as they are imposed on China domiciled firms, and whether those that trade in the US have the same amount of transparency into their financials that are required of firms listing in the US from any other country. This is something which I think if there were goodwill in the two capitals would be resolvable. But in the current context, seems to be getting worse, not better, in terms of the worse, meaning the higher likelihood of more challenges for firms trying to have cross-border capital market utilization, it seems to me. I don't know, Thilo, if you have any other thoughts on that one. We've talked about it a lot offline.
Yeah, look, it's not a new problem, right? There has been a series of similar incidents about a decade ago, Sino-Forest and all these companies. So it's certainly not a new problem. It's a very prominent one, and there were a lot of prominent advisors involved. So it's certainly taken it to the next level. We may see some legislative action in the U.S. I think that's one of the few proposals that actually stands a chance of getting somewhere. But in the long run, the question is, what are the alternatives for Chinese tech companies to go IPO? There's Hong Kong, and then there's the domestic market, and so I think looking at the question from this angle is probably the most useful. And for my part, unless there is a more aggressive action in the U.S. that is really going full blown into a financial warfare, delisting and preventing any company from listing in the U.S., I do not see this going away anytime soon.
Yeah, I'll just add a quick comment, Steve, to what Thilo and Rebecca had said about that. I mean, yeah, I agree. I mean, there's definitely demand for it. I mean, U.S. is still, the best capital market in the world to get liquidity for these businesses. But I guess I would point to it as a bright spot in the relationship. In other words, I'm the eternal optimist. I look at the positive aspect. I mean, it's definitely something that Chinese companies have benefited from, in the sense of listing in the U.S., or at least attempting to list in the U.S., imposes a certain level of compliance and transparency, and Thilo alluded to the accounting issues there, but that's been a net benefit to China in terms of bringing those kinds of standards to the market. And before that was happening, it was a mess over here. I mean, looking at balance sheets and income statements, it was just a complete mess. And now it's much, much better. And so again, we're still waiting for the thank you letters, to all the different benefits that China has gotten from the integration with the U.S. economy. I would say that this is one of them. I'm just kidding. We're not literally waiting for a thank you note, but it is an example of a positive aspect of how this relationship has worked and should work and could continue to work in the future. We're all hopeful that we can get these current issues resolved and get back to a much more cooperative footing. And to the point, I mean, yes, Sino-Forest is sort of where it all that was the first big, spectacular short selling opportunity in the market. But we've seen fewer and fewer. I mean, Luckin was a bit of an outlier. I don't think we're seeing quite the number of short selling opportunities, or outright frauds, and that's a good thing. That's a good thing for everybody. It's a good thing for China. Benefits their reputation in the long term. Yeah.
The Chris Mark again. This way, I guess is for Thilo. Is U.S. FDI in China primarily new money, or is it from retained earnings of China-based subsidiaries? And is there a trend in this area?
I would say it's really a mix of both. It is increasingly, if you look at the last 20 years, of course, it has shifted from new money to retained earnings, and increasingly also local fundraising, right? So we must not forget a lot of the big projects like Tesla's Gigafactory was financed by local Chinese bank lending. So money is actually, most of the money is not coming from the US, but it's raised onshore in China. So there's certainly a shift historically, but there's also new investment. And I think a lot of the new money that's coming in, it really was over the past decade, were SMEs from the US, small medium-sized businesses that saw initially thought the Chinese market is too complicated, but then saw an increasing opportunity in high per capita GDP markets like Shanghai moving over. And I think a lot of that is new money. And I don't know, Ker, if you have any additional insights from where you're sitting.
Yeah, I mean, it's definitely retained earnings. Most of the companies do reinvest the earnings that they get here. Yeah, except for those companies that don't see a growth path. I think back to the question earlier about the Made in China 2025, and what are the sectors that are really not available to China in terms of growth? And you sort of look at companies in the network security space and telecommunications infrastructure. These kinds of companies. They're not going to reinvest retained earnings, right? Those guys are going to repatriate those earnings because there just isn't the growth opportunity for those types of firms here. And to segue over, to answer the previous question about, what are the most important? I think those are important companies. They're important strategically for the United States. To have those companies be truly global, and to be global, you have to include the China market. And so we would like to see those sectors open, especially, cloud computing, some of these other things, some of these other businesses where the U.S. frankly has an advantage. We should win those battles.
Yeah. It's an interesting, we're seeing very slow opening in the financial services sector, which is going to move the numbers somewhat going forward. So I guess for all of you, any chance we'll see progress in, Facebook, Google, YouTube, Twitter, foreign media, cloud computing? Any chance we're going to see, Dan talked about green shoots. I didn't hear any green shoots in those areas, but any chance that the Chinese may decide, hey, let's just throw open. We have enough controls in our society today. We actually can allow foreign companies in these sectors. Any chance of that?
Who's going to take that one first?
Not in media.
I'll give you the short answer. I mean, the short answer is no. You're not going to see Twitter or Facebook despite Mark Zuckerberg's best efforts, heroic efforts. No, you're not going to see that anytime soon. You may see, but you threw in cloud computing, and so on the infrastructure side, perhaps. But again, that's probably going to be more negotiated, on basis of reciprocity, things like that. But on the media side, frankly, it's the opposite. You are seeing China. Frankly, it's becoming more repressive, more authoritarian, deeper control into social media. So no, they're heading in the opposite direction. So I wouldn't anticipate that. You mentioned financial services. Yes, definitely. That's an opportunity. We talked about asset management earlier, but broadly speaking, in financial services, you're going to see more opportunities there. Wholly owned securities firms, wholly owned insurance. Those again, COVID notwithstanding, so let's see how quickly the recovery happens and those opportunities present themselves. But financial services is a bright spot. You mentioned quickly. We would respectfully disagree. From our perspective, we've been pushing on that for so long, and we've frankly been scratching our heads over it because we don't see why China has been so slow at liberalizing their financial services market. In other words, just look at commercial banking. Does anybody think that there's a threat to Chinese banks coming from the foreign banks coming in and all of a sudden dominating retail banking and corporate banking here in China? Please, I mean, the big five banks are enormous, and they're actually in a competitively advantageous situation relative to the foreign banks. So why there hasn't been faster liberalization in that market, we have no idea. It was a long time coming. Should have been more open much earlier for China's own benefit. And one thing that's kind of interesting is how they backed away or quietly buried this plan to make Shanghai an international financial center by the year 2020. Here we are. That's been a plan on the books for quite a long time. They are nowhere near becoming an international financial center.
Dan and Thilo, anything you want to add on that? Because we're about out of time.
Yeah, I think one exception to the sort of media internet assessment is if there are firms that are able to carve out certain parts of their businesses and apply it to the Chinese market. I mean, Facebook has big operations in China on the game app developing side, for example, or quite interesting if you look at what TikTok is doing in the U.S. market, right? If there is a way for them to try to really localize operations and customize it, obviously for U.S. firms, there's too much civil society pressure to give up some of those principles, as was seen with Google back in the days. But if there's a way for them to make that compromise, then I do see that some U.S. firms could take advantage of some of these.
So many U.S. technology companies have failed in China. And so even if Twitter and Facebook were allowed in, they're competing against Chinese companies that are in some ways more innovative and advanced than the American counterparts. They already have WeChat, for instance, which is more functional than what we have in the West. So even if they were allowed in, would the Chinese consumers want it?
Yeah, it may be too late. Can I close with my favorite question to Dan and Thilo, which is, what's the number going to be for 2020 of FDI?
Thilo had a golden opportunity to take my $100 bet about that a couple of months ago. And I think he walked past that $100 bill. But Thilo, why don't you put our official Rhodium number on the table?
Since this is on the record and it's going to be available for the eternity, I'm a little hesitant, but I think we actually saw already one big investment close, Tencent buying a big stake in Universal Music in the first quarter. So looking at completed investments, if I would have to take a guess, we'll probably end up in a similar at a similar level as last year in 2020, so around 5 billion plus minus. And U.S. to China, I would say we go down somewhere around 12-13 billion this year.
Go down. Okay, that's a COVID-driven number, partly.
I would say it's always a little hard to track these changes in capital expenditure in plant and equipment, right? So if big U.S. multinationals are making these adjustments, that's not something that they want to announce publicly. So it always takes time to find these things. But yes, I would think quite a few companies will at least put a temporary halt on more aggressive expansion, and that will lead to the number being pushed down a bit in a short run. Yeah.
Great. We've gone past our appointed time, so I know Ker has to go to his day job. Dan probably has to go get ready for bed. Rebecca has to go to dinner, and Thilo has to go to dinner. But this has been a fabulous, wonderful program. I've learned a lot. Thank Thilo and Dan for coming up with all this terrific data. Thank Ker for his comments. Thank Rebecca for her comments. It was a wonderful evening for those of us in New York. And thank you all for joining us. We'll see you soon, in person, I hope.
Thank you, Steve.
Good night. Thank you, everybody.